there are these companies that seem, for now, to just go up and they almost can't go down, but due to index flows.
I probably can't say enough about how corrupt the index companies are, especially S&P.
If those reverse or stop just because of unemployment, you know, he's talking about 1929 style crash.
That's what I'm concerned AI is leading us toward.
People keep talking about how AI will replace jobs. And in this episode, we talk about exactly how AI could take your job in 2026. That's especially if you're a junior associate at a law firm or a software engineer working at a SaaS company. We also dig into the world's biggest mistakes and how corporate fraud plays a role in affecting your money. This is Top Stocks. And today, I'm not talking about a single stock, but I got a chance to sit down with a legendary short seller who bets on stocks going down. This week, I'm at the Future Proof Conference in Miami Beach, and I got a chance to grab Carson Block of Muddy Waters for a quick conversation. Carson runs Muddy Waters, which is a research firm and investment firm that mostly bets on stocks going down. I'm an investment analyst and economist with over 2 decades of experience, but more importantly, I have a huge, experienced research team at Stansberry Research that has done all kinds of incredible things. They've predicted the dot-com bubble and the financial crisis, recommended Berkshire Hathaway at $56, it's at $500 now, recommended Nvidia in 2016, Bitcoin in 2017. This is just what we do. So this almost seems silly to ask, but in a world now where people buy stocks on their phones based on a chart pattern or a tweet, or I guess it's an X post now, why is your kind of deep research so important? What are they missing?
It's an interesting point. The market has definitely changed in the 16 years that I've been a short activist. Sometimes reactions or non-reactions to reports can be more driven by technicals than by fundamentals.
Okay.
That's something that I've learned to look out for, because we had this rough period that started right before COVID and went into COVID. All this retail money came into the markets, where we were learning the hard way that technicals matter. So technicals will, for us, kill a potential short idea, even if from the perspective of, okay, this company is completely dishonest in how it's presenting itself. Even if it checks all those boxes, there are times when we'll say, no, we're just not interested in this because of the momentum there, or we're not interested at this point in time. Now, you get to points where technicals can break down and those can be tailwinds. But the other thing is that I think a lot of short activists have to learn is that you have to attack the bull narrative if you're doing this. So you could say, oh, I've got this list of 5 egregious problems with the company, but if that's not what people are, it's not the reason people are buying it. If it's ancillary, then it's really easy for everybody to ignore what you're saying. So you do have to make sure that you're going at the bull narrative and not talking about something that people are going to, easily brush aside.
It makes me think of, like, if you think Tesla's overvalued and you say their cars aren't selling, they're not that profitable, and people go, I don't care, it's a robot company now, right?
That's the brilliance of Elon Musk.
Yeah.
He has always changed that narrative. Always. I mean, there was one time it was a car company, right? Then it was a solar company and power walls. And then it was autonomous driving company. And then when that turns out not to work so well, like an AI company, or it's going to become an AI company next, but it's a robot company. So he's a master of changing the narrative and staying a step ahead, if not 2 or 3 steps ahead of his critics, who, like, what do we know about robotics right now? We don't know enough to knock down the robot narrative, or, like, how could we criticize XAI, which is probably going to be folded, into it or something.
Yeah,
so
you can see that coming.
SpaceX and
So I'm not asking you to put out a view on Tesla, but that also seems like the kind of company where you're talking about technicals. If you decided you didn't like that, that sounds like something you wouldn't mess with because of the momentum and the Elon factor and index weightings and things like that. Is that what you're talking about when you say there's challenges?
Yeah, and well, I think that plus, well, yeah, but you can't underweight the Elon Musk factor, right? So we are incorrectly labeled sometimes as a firm that had shorted Tesla. What we did, I think, was really smart at the time. So we went long Tesla bonds. Now, those were converts, but they were, I think they were at that point, busted converts.
Okay.
So we went long the bonds, and we were using the cash flows to buy long-dated crash puts on it.
Okay.
And those almost paid off in 2018. But it was a positive carry position for us. Never been naked short the equity of Tesla. So that to me is that's the only short exposure I've ever had to Tesla, is being long credit to fund deep out of the money, long-dated put position.
Okay. And talking about market structure, there are these companies that seem for now to just go up and they almost can't go down due to index flows. Does that make your job harder?
Yeah, it does. And I mean, the worst thing, so one of my revelations, like I probably can't say enough about how corrupt the index companies are, like especially S&P. Okay, so S&P, when it thinks about inclusion into the S&P 500 index, become clear to us it's just chasing momentum, right? So companies that have gone up a lot, they are a lot more likely to get added to the index regardless of quality of company, sustainability of business, et cetera, et cetera. All the things that might have once been considerations for inclusion or serious considerations, I think that's gone out the window next to, is the market cap big enough? Yes. What's the momentum?
Yeah.
So the thing that we've had worse time with in recent, like past year is companies that are ramping on, like a false narrative, and then they get added to the index.
Yeah.
That's the worst. Now, it turns out when something has had a big run up in front of inclusion to the index, this is something we're studying, then within the first 1 to 2 months, that might be a good time to actually publish, because you have exhausted a lot of the buyers. The index funds have already gotten into it. And so that might be the point at which, if you can go at the narrative, you might be able to break that momentum. But that's a theory. We don't, the N on this is kind of small.
Yeah.
So it's hard to test it. But yeah, that's a hard lesson that we've learned, is companies that could be included in the index, or stocks that could be included in the index and are ramping strongly, be careful of those, because there's a good chance S&P will say, hey, it's up 140% in the past 12 months. Obviously, we wave it in. Oh, but they don't have a real business. That doesn't matter.
And so people buy an index fund and they think, I'm buying the market. No one's making these decisions, but they are all decisions, aside from maybe the total market funds. And isn't it, I think it's NASDAQ who is accelerating the timeline so they can let SpaceX into the NASDAQ quicker than they would have normally. And that's just because people, investors want it. They want that momentum return, and it's going to be a very expensive stock when it comes out.
Yeah, I mean, it's been almost 18 years since there was a sustained correction. That was the GFC. And what did we learn in the interim? We learned that in 2020, if things get bad, the government is going to stimulate. So what that has done to people's risk aversion, I think it's almost completely eliminated it in, as far as the broader market is concerned. So yeah, I think so long as we're in this environment where people are inured to risk, there's not a lot of penalty for them to operate that way.
Yeah. You've also been taught, as every investor has, doing a lot of work on AI. And I think you've got concerns about certain companies and concerns about employment.
So the way I think a lot of people have done work on AI, for me, it was really reluctant. Like I'm thinking, this is noise. No, I'm not going to look at it and tell you whether I think NVIDIA is overvalued or fairly valued or undervalued, or like, who cares, not interesting. But, in the past 4 to 5 weeks, I've done a complete 180 on my economic and market outlook. So I did a podcast in January, and I was so chilled out. right? So we developed this long strategy in our firm where it's a systematic strategy, meaning it's quant. It's basically we go long 20 S&P 500 constituents.
Okay.
We're sniffing out momentum, and the numbers on that had been sick. And the point that I was making when I sat for that interview, I said, look, the index is generally just going to grind higher. I mean, if rates are increased, you get like a blip, but it's going to grind higher because you have all of these flows that just keep coming in through, especially through 401k funds. Yeah. And so unless you are concerned about the employment picture, there's no reason to think that abates anytime soon. And I think my words were something to the effect of, as I look out on the horizon, I see nothing that makes me concerned about the employment picture. Okay. And then I did a 180. Yeah. And so the first thing was maybe about 6 weeks ago or so, all those software companies, when the new Claude model came out, all those software stocks just got pummeled. And I'm asking around at my firm, like, does anybody understand this? I mean, wouldn't this be a good thing for software companies because they can become more efficient and fire developers? And so, I did a little bit of research, and it's like, okay, SaaS revenue. So there's concern that the customers are going to be getting lean and getting rid of users. Like, well, that doesn't sound like that's getting rid of just developers. That sounds like it's getting rid of non-developers, like other people. Like, So started playing with the newest version of Claude. Mm-hmm. Wow, okay. This is not my father's ChatGPT. Not that he literally uses it, because he can't even use a cell phone, but okay, this is that, like, let's see if it can do my new estate plan. Holy shit. Yeah. These docs look pretty legit. Like, I have to get them to an estate attorney to take a look, but wow, like, I uploaded the old plan. It asked me some smart questions, joint spousal trust or separate spousal trust. And then I got these docs. This is interesting. Then I learned that the current versions, the newest versions of these AI models were coded by their predecessors. And so what we have here is, it's not a linear progression from the prior version. It's a step up, okay? And it was coded by predecessors, and it's coding successors. So we are about to climb a wall here. This is the inflection point where it goes exponential in terms of the capability increase. So, okay, that changes my worldview here. Let's go back to what that means about culling seats, and so then I learned that the best users of the current generation AI model, so these are people who are in technology, they're developers. They've been able to take 8 developers, and compress it down to one sophisticated user of AI. So basically, out of 8 employees, the companies that are really good, or people who are really good at using this, are able to drop 7 people with the current generation. So now I'm thinking, okay, well, if you've got a ratio of 7 layoffs out of 8 now, based on current generation, let's look 2-3 years down the line. Yeah. The capabilities of these AI models, they're going to be far beyond where we are now. And okay, I'm not going to say that knowledge workers in general, 7 out of 8 are going to lose their jobs, but could 1 out of 8, could 1 out of 7 lose their jobs on average? And the answer to me is, yeah. I mean, in terms of capabilities, like, I deal with a lot of lawyers. I'm a former attorney, and I mean, I got to tell you, this can do so much of the billable hour, like, ridiculous, labor that we pay for. Yeah. So in, this one litigation I'm involved in right now, we just got a big data dump in discovery, and it's like, man, you know what? Don't throw junior associates at this. Okay, Claude is going to do this. Oh, well, we don't know how to use it. Okay, we're going to show you. We're going to explain this to you, because, guys, and I've told this to both law firms, being totally serious. All right, the old model is dead. Okay, so if you guys don't get on this, like train right now, like I'm going elsewhere. So I'm dragging them into, into this era. But getting back to that point about, how many workers could lose their jobs over what point in time. So if 1 out of 8, 1 out of 7, that's roughly 15% of knowledge workers losing their jobs, say within 3 years. What that will do to demand, it's going to be crazy, because these are like the highest paid workers, in the economy. We're not talking about, I mean, historically, technology has taken out generally the lower paid jobs. So, and we're talking people who have student debt, and you see this starting to show up in numbers. I mean, graduates are not getting job offers, especially graduates in computer science, MBA graduates.
Yeah, so with these AI models, I had kind of long been in this view of what they call AI as normal technology. And that was like an argument that these models are cool and they're doing a lot of stuff. But in the end, they might not be as transformative. They might just, almost like Excel, like make people 20%, 30% more productive, just like the PC era. But you're right, in the last few weeks, things have really accelerated, starting in like January or February, where they've gotten a lot better. And that view seems less true now. There are still some of like the old, the top AI guys say LLMs will only get so far, but if they're improving themselves, that's a really big milestone.
This is going to be a problem. But getting back to, and I guess let me just present the counter arguments. Okay, so there are two counter arguments to the concern that 15% or more of knowledge worker jobs can be gone in 3 years. One counter argument is the adoption curve. Okay, well, in theory, companies could start doing it, but people are lazy, this and that. Yeah, I get that. But I think this is different because if you are, I mean, many businesses, service businesses or knowledge businesses, I should say, if you don't start adopting this and getting lean, there will be single person startups who will be able to kick your ass in the marketplace and underprice you. And as a thought exercise, I've asked myself, in 6 months, if I were starting up a hedge fund in 6 months or in 12 months, how much do I think I could cut my upfront costs with legal?
Yeah.
Significantly. Probably the compliance costs. We pay an outside firm just to deal with our Form ADV. Like, I don't understand why that costs tens and tens of thousands of dollars. That would be gone. We could probably scale our business without adding the headcount that historically we would need to. So that's the thing. If you are too lazy or set in your ways to adopt this, you will have competitors who come along and say, I can price whatever service you're in for 20, 30% less. Then what do you do? Yeah. So that's why I think the adoption curve, actually, that argument, I think that's why that falls flat on its face. And there's probably going to be a longer lead up, but a bunch of businesses are going to have these law firms are going to have these oh shit moments where they realize their clients are saying to them, as I'm saying, I'm not paying for your junior associates to, spend 12 hours a day poring over these documents, probably missing some important stuff when this can do it much better. So you have that. The other pushback is what's called Jevons paradox, which is we've always had these freakouts about technology. They destroy jobs, but it turns out that they create new jobs. I don't dispute that. Why I think that doesn't apply in this situation is, for a number of years, I've thought that I've said that where the technology we've created it's so powerful that we're not able to adapt our inventions and innovations before they do something that's really problematic. So whether you're talking financial technologies like credit derivatives, which blew up in, culminated in 2008, deep water drilling technologies, Deepwater Horizon. So already with technology that was not improving at an incremental rate or increasing in power at an exponential rate, already we have a hard time adapting. So
Right,
when
like these highly technical things are on such a cutting edge that policymakers are so behind.
Well, it's not just, I mean, like how can we as, as a workforce adapt? I mean, you might, take however long, you need to learn how to use Claude. Oh, it just coded the next Claude, which is, 3x as powerful, and it codes the next one, which is like 9x as powerful as the one you learn how to use. Okay. So I'm not saying all jobs are gone. I'm not saying that it doesn't create new jobs, but when I think about that dynamic, I don't think that a 15% reduction in knowledge worker jobs in 3 years is beyond the pale. I mean, I could easily make a case for it being more. And if it's not within 3 years, then I would really think it's within 5.
Yeah, the other thing with Jevons paradox that I'm trying to find out is how much of these software layoffs are actually due to productivity gains, and how much is like they call it AI washing, where they had to make layoffs anyway, so they say, okay, well, we can do all this with AI. And so you look at Block, the company, and they laid off 4,000 out of 10,000 people. They probably didn't need 10,000 to begin with. They say it's because of AI productivity, but I think only time's going to tell how much of those jobs AI can actually do.
And again, think forward here. What happens to demand? Like what happens to all those workers, carry that debt, live nice lives, consume a lot? I mean, this is going to massively reshape the economy. So, and I'm 180, all right? If you look at me in January, I'm totally chilled out. But, the implication for the S&P 500 is these are the workers that are contributing to the target date funds, and especially the ones that are heavy on the equity buying. So if you get a point where those flows taper off and they become net zero, and then eventually people have not found jobs and they got to pay, then they start redeeming early from these 401k accounts. And this is where you get to Mike Green, and,
yes.
And this is the boom, 1929 magnitude crash at, he used to call it 2020 speed.
Yeah.
So that's my concern. And we're positioning for that.
We just, a couple of my analysts and I just went and saw Mike Green talk, and we walked out of the room, and we were basically like, it was like coming out of a good movie. We were like shell shocked. We're like, we don't even know what to say right now, because we talked about it on one of these episodes recently. All this money going into index funds is driving it up. If those reverse or stop just because of unemployment, he's talking about 1929 style crash. I think he said in the next 2 years, but.
Well, that's what I'm concerned AI is leading us toward. And again, like rewinding, 5-6 weeks ago, I didn't see that on the horizon, but I believed that unless something changed structurally in how we deal with the indices and target date funds, that would be the eventual outcome. But, look, and the policy error that I think is going to be highlighted there is, well, I mean, the most direct one is the Department of Labor rule about, fiduciary responsibility. It's never been fleshed out. So all of these advisors basically began interpreting it years ago as, well, if I'm a fiduciary of client assets, I have to seek the lowest cost product. Mm-hmm. And so the lowest cost product were the index funds. And so the index funds used to track the market. Now they make the market. And that, Mike has been banging that drum at policy levels for several years. And I think nobody either gets it, cares, or feels like there's the political will to do anything about it. So
it's too big. It's just too big of an idea and there's so many people would be disrupted if we had to go, look, these index funds can't exist anymore. They just don't want to hear it.
Or there have to be caps of some sort. And I don't know what the right prescription is.
Yeah.
Because then you have all of the index huggers, right? Like all the active managers who are basically like mirroring the index, overweighting the stuff they think that goes up, underweighting the stuff they think that goes down. How do you police that?
You just heard Carson explain why he recently completely changed his outlook on AI. And that's because for a long time, there was good reasons to question how good these models can be and how powerful they could get. But in the first couple months of 2026, there was huge advances out of Anthropic and Claude and other LLMs that make them look a lot more powerful. So investors have changed their tune. Now, if you find this interesting, this is exactly the kind of stuff we cover at Top Stocks. We're here to teach investors how the market works and make them more confident about getting into the stock market. You can sign up completely for free and learn more at topstocksletter.com. All right, so just to set the table here, index funds just buy all the stocks, so to speak. They don't have a manager who's deciding, so they have low fees. But those have been growing in proportion to the market. And if they control too much of the market, there's no one deciding on how to price these stocks. So that can be an issue.
But, like John Bogle, apparently before he passed, he expressed concerns about how big index funds had become. And that, my understanding is, he was concerned that they were too large a part of the market now.
Yeah. And there's all sorts of models to kind of go, where is the point where it's too much? And wherever you kind of fall on that spectrum, we are past the easy points and we're heading to where it's just completely no discerning in the market. Just buy these stocks without judging them against each other. And so to get back to fraud. So if people are putting money in their index funds, they're not assessing businesses, and there are frauds out there. What's like a new investor to think? There's kind of a philosophical question, like, are most people good or are they really bad? Like, are most companies good? Like, how much do you have to worry about fraud? Accounting doesn't tell you everything, but how much are companies actually lying to their investors?
All right, so the good news is there's not a lot of fraud in the market. It's just fraud is expensive when it's there. The bad news is the world has long had a bigger problem than fraud, and that's the gray zone. And so the gray zone, the number of companies in the gray zone, and what I mean by gray zone is it's not legally fraudulent, right? Like lawyers have looked at these things, but it's intellectually fraudulent.
Okay.
That gray zone, the number of companies and people and parts of our society that operate in that gray zone has expanded tremendously since the GFC. And I think that's our bigger problem. So when the tide next goes out and a lot of these companies turn out to have not been what the markets thought they were, or at least what they were telling investors, I don't know that there'll be that many convictions.
Yeah.
But, people will, and, when we publish on a company, I had this revelation, or this thought, I should say, back in 2020. We published on a company called eHealth, April of 2020. And they had just adopted a new accounting standard that allowed them to spin a model that would present value their net income from new signups.
Okay.
And so suddenly their earnings just exploded. And the market knew that it was a new accounting standard, but nobody really cared to, try to compare it to the past. But what the behavior it incentivized was they started really trying to add customers. These are Medicare Advantage subscribers. And so they just blitzed late night TV with ads for low cost or free Medicare Advantage plans. And so you're getting a bad quality customer that's not sticky. But who cares? The models that they were spinning were based on the prior stickier customers, pre-accounting standard. And so anyway, and look, stock's down huge since we wrote on it. I mean, at one point down in the 90%, I think, range, but I don't know where it is today. But I had this thought when we wrote on this, and, I heard from somebody who's like, look, I know the CEO of the company is actually a good guy. He was probably sitting there going, why us? Like everybody's doing this sort of thing.
Yeah.
Why pick on us? And, the answer is just look, your number was up. I mean, it came to our attention, but yeah, if that was what he was thinking, that would have been correct. That there's so much of that gray zone stuff. That wasn't illegal. It was just massively distorting the truth.
That eHealth example is almost direct parallel to Enron, where it was saying you take the future value, you say, hey, we've booked that future value. And we had Andy Fastow, the CFO of Enron, at a conference. Andy. And this was probably 15 years ago. And he gave a talk and he was basically like, we followed the rules. Like, all this was signed off on. You can make a lot of judgments in these areas. And I was sitting next to a guy who had been an Arthur Andersen accountant who lost his job when Arthur Andersen went under after Enron. And it was just wild because he was right. Like it's the gray zone.
Yeah, like Enron is really misunderstood for this reason.
Yeah.
Okay, so everybody hears Enron like, oh, massive fraud. No, it was a company with a then massive market cap that imploded almost overnight that had a little bit of fraud. And I think the only reason that fraud came to light was because it was such a shock at the time it happened. The DOJ flooded in and they're looking through the wreckage and there has to be something to prosecute here, right? And so they found some stuff that was on the margins. The principal reason why Enron imploded was, like, Andy's not wrong, right? The accounting allowed them to produce financial statements that were nowhere close to being representative of reality, and they were not prosecuted nor convicted of that. And so I came to know Andy several years ago, and we were talking through a company that was of interest, in the public at that time, was a commodities trader. And Andy was talking to me about what they used to do at Enron, these total return swaps and forwards that basically allowed them to turn debt into revenue.
Right.
And also, look, Lehman ended up doing this with Repo 105. They were borrowing money, but they got to book it as sales. And I've since seen other companies do this. And so when I asked him, I was like, well, okay, so these were really financing cash flows that you dressed up as operating cash flows. I was like how large was the mischaracterization here?
Yeah.
Again, this is all legal. And so I believe he said, well, in our last full year of reporting, that was 2000. I think we reported, he said $2 billion in operating cash flow. And of that, the financing, that were really financing cash flows, that number was $2 billion. And again, that's legal. Like the only thing that stopped that at the time was there were these intermediary banks. Like if you Google Mahonia and Enron, or just Mahonia, it'll probably come up. It'll tell you which enormous bank that's still around today was facilitating this. Right? The banks, for a little while, they thought, oh, this is a little sordid, reputation risk. But they all, like everybody returns to doing this sort of thing and facilitating these kinds of transactions for their clients. Like that happened years ago, whether they returned to doing that. So, it's the gray zone. That's the world's bigger problem. And I think I've observed that there's an inverse relationship between basically interest rates and dishonesty. So the lower rates go, the more stimulative monetary policy is, the higher the level of dishonesty in the society
and it
goes.
Accumulates over, like the longer rates are low, it stacks up more and more dishonesty.
Yeah, well, I mean, look, if, average person looks up, who's sitting at the top of our society, right? Do I think these people operate in an honest manner?
Most people would say no.
No, and I mean, stuff that comes out with like the Epstein files is certainly not, dispelling that perception. But when you look up and you see who's becoming most rewarded, and what they do, right? How they operate. Okay, what does that say to you as the average guy? Do you think like, oh, well, you know what? I'm going to walk the straight and narrow and set an example? Because who's setting the example for me and for my kids? Right? That's how this cascades through society. The lack of dishonesty.
You saw that with Adam Newman and WeWork.
Lack of honesty.
Adam Newman and WeWork. The whole game was just fake it till you make it. And the more crazy he was, the more capital he attracted.
So you know what's fucked up about that? Right after it collapsed, I sat down with a venture investor who'd been early, and I'm full of myself. I'm like, listen, I could have told you this guy was a fraud. Okay, first of all right, he's Jewish, but he wants to be mistaken on the street for Jesus Christ thing. Okay. That dichotomy, okay, there's something inherently dishonest about that.
Yeah.
Then I loved when it came out that the guy who's always claiming to be vegan eats meat.
Yes.
Okay, that guy, that would have told me everything I need to know. He's a charlatan. And this VC investor said, we made 8X on WeWork anyway. He was the best salesman who's ever come into my office. If he came and pitched me on something again, I would do it in a heartbeat.
And they did. Well, it's funny. It's funny because you're starting to get a little worked up about Adam Newman. And I remember years ago, you've been in the short game a long time and it's a hard game. And years ago, you did an interview where you said like, at your core was like a rage that just wouldn't let you let this go. Like that was what was driving you. But you don't seem like a rageful guy. Is it just that dishonesty and that fraud that you have to call people out?
No, I can laugh. There's an old expression.
Well,
like,
you don't walk around
I don't
angry.
know whether to laugh or cry.
Okay,
like,
fair.
what am I going to do? Like, go around and like punch people in the face all the time? Like, it's totally fucked up. But I've often called what we do in activist short selling, especially when we're looking at real hardcore frauds. I've often talked about the financial comedy factor. And every now and then when I presented at like an Irisone and I I kind of felt like I was doing stand-up financial comedy as I'm just, this is what these guys claim. But
the
this
stories
is the
and
reality.
fraud.
Like, come on. Like, there is, in a sick way, like if you put aside the consequences and, like I've spent and still do spend at times plenty of time, like, crying for the world. You can't do that all the time. All right. So sometimes you got to put that to the side and try to find the humor in it, or just, look, I think where a lot of short sellers, especially guys who've gone out of business, I think there's a lot of mental illness in short selling. I'm not being facetious here, like, oh, you got to be crazy to do this. I mean, like, genuinely, whether they're people who were activist short sellers or the traditional short sellers. And I think people who are drawn to this, especially people who short the companies that are scammy or fraudulent, there is an element of, I want to make things right. I'm really distressed by things that are wrong. Almost everybody who was in this game or entered while I've been in it has exited. And I think part of it is the mental toll that it takes, not just because, oh, I'm losing money, I'm getting squeezed. Everybody thinks of that mental toll, but if you're constantly focusing so much on what's wrong with the world, it can really mess you up mentally. And that's one of the adjustments I've had to make over the years to stay in this is identifying when I'm getting kind of pulled down into that vortex and stepping back and focusing on my life and the good things that are outside of this. So, what you see here right now is the product of that understanding. If you rewind some years ago, no, I wasn't as good at that, or maybe even aware of that issue. Yeah.
And I feel like that's something, when you talk about these AI job losses and everybody is really worried about a lot of stuff right now between politics and all that, I think you have to find a way to step back from, there's always something to worry about in markets. And if you focus on them too much, you forget that there's a normal life out there.
Yeah. And look, I've had a very hard time that the past, since I came to this revelation, like I said, 4 or 5 weeks ago, I've worked harder than I have in years in terms of hours. And I've had such a hard time sleeping at night. And, and a big part of it is, waking up, like just, so as much as I was just saying, you have to learn how to distance yourself from, the ills of the world that you perceive. This is one I am having a hard time dealing with. And I've gone into the office so many days, like just looking bedraggled. And it's like, oh, you've been up, since 3 again? Like, yeah, I've been up since 3 at my computer since like 3:45 when I finally gave up on trying to go back to sleep. And so yeah, like that is a dynamic. The ideal is that you can distance yourself.
Well, take this in the spirit I intended. I hope you're wrong on your prediction.
I do too. I do too. Like I'm like, my business is okay if I'm wrong. Like that's fine. I don't want to go into that world. I'm not a proponent of it. I always hated when I met tech guys, who deliberately try to speak as though they're autistic and say like, oh, I'm working on AI. Like, well, what if that goes wrong? Well, then that's just the natural process of evolution whereby one organism fails in favor. Like, shut up.
Yeah.
Like, I don't want to be in that world, but I think we're going into that world regardless.
And you've seen that survey where they surveyed AI researchers, and it shows how many of them think they might be creating something that will end humanity. And it's like 20% of them consider that a real risk.
Yeah. Look, I can't get I don't have a view there. I'm not talking about like, your oven suddenly like, slamming you in the head with the door, because it's become self-aware.
Yeah.
Yeah, maybe. I don't know. I mean, we've all seen the movies, but
But why would they work? I don't know if that's true, but they think it might be, and they're still building these things. It's kind of it's a unique situation.
I mean, again, like there was always this thing with tech people to, like that came into vogue. At least it was in vogue ever since I moved to San Fran in 2010, to put on this affectation of like, I'm autistic and I'm trying to pretend to be autistic. And, I want to speak with as little empathy and humanity as possible. And, and hopefully if I speak that way enough, my thoughts will actually become like that. But when I would ask these douchebags, like, why?
Yeah.
No, like, if I don't do it, somebody else will. Not wrong. I mean, I think the understanding that I took out of those interactions a long time ago was that, people who are driven, you want to accomplish, right? You set goals and you want to meet those goals. Okay, these are really impressive goals at an individual level. If I could be the first to solve this, to do that, these are challenges. Like, they were intellectually stimulated by it. So I don't think that most of them started off with the mission of ending humanity. And like I said, I don't know that we're going to be fighting our toasters or not. I'm not. I have no view. But but I think it's a combination of individuals achieving, knowing that they're competing with other people who are looking to do the same thing. And I don't know. I hope this doesn't go substantially worse than I think it's going to go.
All right. Well, we'll have to keep an eye on it. Thank you so much for joining me.
All right. Thank you.
Nothing we say today should be considered investment advice and should be used only for informational purposes.